Investing in retirement is different. Volatility, cash flow, sequence of returns, these become the new priorities when you start taking portfolio withdrawals heading into retirement. One of the mistakes that I see people make is that they only have their equity position allocated to the S&P 500 index. And it makes sense. The S&P 500 has just been doing incredible the last couple of years. It's been one of the strongest performing asset classes. But it wasn't all that long ago that the S&P 500 was on the weaker end of the spectrum when it comes to performance. And one of the things I'd like to do in this video is explore that time period that's known as the lost decade from 2000 through 2009 and help you to understand why having a globally diversified portfolio can really help you weather the storm once you start taking money out of a retirement portfolio. Most people have heard the term, don't put all of your eggs in one basket. Harry Markowitz was a Nobel Prize winning economist, and he once said that diversification is the only free lunch when it comes to investing. Not being fully diversified exposes investors to greater uncertainty. And the reason for diversification is because we're trying to eliminate extreme outcomes, especially on the downside of the spectrum once you're retired. Because once you're retired, you can't afford to recover. You can't afford to make up for lost time. What you have is what you have, and now we need to make sure that this money is going to last for the rest of your life. Did you know that 10 companies currently represent about 30% of the S&P 500 index? And 2 companies, Microsoft and Apple, each represent about 7%, 14% total just between those 2 companies. So if you own the S&P 500 index, you may not be as diversified as you think you are. The next thing that I want to do is look at the equity returns of developed markets. And so you can see from 2003 through 2022, the United States was only the best performing developed market one time during that period. And so investors who are globally diversified have a much better opportunity of capturing the returns no matter where they occur in the world. The next thing that we want to do is we want to understand what history can teach us about having all of your money just in the S&P 500 index during a time when you're taking portfolio withdrawals. And so what I did here was I assumed that you started with $1 million, you were 100% invested in the S&P 500, you took out $40,000 the first year, you increased your withdrawals every year by inflation, and you rebalanced your portfolio every year. So the first thing that we'll look at here is the S&P 500, and you can see you end up with $415,000 if you started with $1 million in 2000. By the end of 2009, with portfolio withdrawals and market performance, you only had $415,000 remaining. So in this next example, the United States represents about 60% of the global market cap. International developed, excluding the United States, represents about 30%, and emerging markets represent about 12%. So in this next one, I said, well, okay, what if we had 60% in the S&P 500, 30% in international developed, excluding the United States, and 10% in emerging markets? How would you have fared if you had an all-equity portfolio but with global diversification? All things being equal, you started with $1 million, you took $40,000 out a year, you rebalanced every year. You notice the difference is with the S&P 500, you had $415,000 at the end of 2009 versus $548,000 with a globally diversified portfolio. Now, the last thing I would say is I know some of you don't like the idea of owning bonds or fixed income, but I want to show you why that's important. So in this next model that we created, we still are going to use the global market capitalization for determining our equity allocation, but then we're also going to have 40% of the portfolio allocated to 10-year U.S. Treasuries. So now you can see we have 36% in the S&P 500, 18% international developed, 6% in emerging markets, and 40% in 10-year Treasuries. And you started with $1 million, you rebalanced every year, you took $40,000 out, adjusted for inflation every year, and at the end of that period, you had $943,522. Now, of course, past performance is no guarantee of future results. We're just looking back at history to help us understand the benefits of a globally diversified portfolio during a period of time that was rather challenging for the S&P 500 index. Remember, there's something called recency bias, and recency bias tells us that what has happened recently, we think is going to continue to always be that way going forward. And we know that the market doesn't work like that. Before you come up with an investment strategy for retirement, the most important thing you can do is come up with a retirement cash flow plan. You need to have some idea for how long you're going to live, how much money you've saved, and how much money you spend. And when you have all those things, you can put them together inside the retirement budget calculator, and it can help you create a cash flow analysis to see if you've saved enough to support your spending over your lifetime. So in this very simple retirement projection, you can see in this hypothetical example, the green line is the year of retirement. You notice they're going to have Social Security income and some pension income, annuity income. Their budget requires $89,000 a year, but they only have $54,000 of guaranteed income. So that means they're going to have to take portfolio withdrawals of about $34,000 per year. And you can run these numbers down, assuming that they're only earning 3% per year. And you can see that we make it to his life expectancy at age 82 and her life expectancy at age 85, and there's still $1.1 million remaining. The other thing that the calculator can do is help you visualize what it could look like to diversify your money across time segments. So the idea with buckets is that money you need in the short term, money you plan on spending in the first 1 to 3 years, you want very little risk. You don't want to be taking money out of accounts that are falling in value. So bucket 1 would represent the cash flow that's needed from your portfolio for years 1 through 3. And then you have years 4 through 6, which you could have more of a conservative portfolio. Years 7 through 9, you could take more of a moderate approach. The idea is that as you have more time, you can afford to take more risk. And then this last bucket is the bucket that we don't need to touch for 10 years. So this is where you can have more of your equity position. I hope you found this helpful. Thanks so much.